While multifamily, office, retail, and industrial commercial real estate tend to make most of the headlines in this industry, these aren't the only types of properties that exist in the market. And with interest rates most likely staying higher for longer today, a lot of real estate investment and development firms have started to become more interested in alternative property types that can generate strong returns even in a challenging interest rate environment. So in this video, I want to zoom in and highlight two specific niche asset classes that are definitely worth paying attention to in 2025 and why these sectors are gaining so much traction right now with institutional investors. So the first asset class I want to talk about here is data centers, which has been one of the fastest growing sectors in commercial real estate over the last few years. According to Avis & Young, in the fourth quarter of 2024, U.S. colocation data center inventory grew by 47.5% year over year, while at the same time, vacancy rates for these properties dropped to an all-time low of just 1.6%. And because of this surge in demand and the lack of available inventory, average wholesale data center rents have increased by anywhere from 30% on the low end to almost 44% on the high end since 2021, and interest in this sector from REITs and institutions also increased significantly in 2024. Net absorption in this sector also hit record highs in Q4, up by over 15% from Q4 2023 figures, and markets like Salt Lake City, Northern Virginia, and Portland, Oregon all saw vacancy rates of less than 50 basis points in the fourth quarter of last year. And even while JLL is forecasting an additional 15% compound annual inventory growth rate through the year 2027, the demand for this product type is very likely to keep up with this pace, with Microsoft, Meta, Google, and Amazon spending a combined $108 billion in 2024 to build AI data centers, according to Newmark Research. Microsoft specifically also recently announced its plans to double their spending on building AI data centers to $80 billion in 2025, and since the launch of ChatGPT in November of 2022, U.S. private data center construction spending has almost tripled during this time. Also, while investment sales volume has basically fallen off a cliff over the last 3 years for almost all commercial real estate product types, data centers have seen some of their highest sales volumes ever since 2021. Data center M&A deals also reached $73 billion in 2024, more than 40% higher than the previous record of $53 billion back in 2022. And with companies like Blackstone making huge investments in the sector today, this is one of the most interesting parts of commercial real estate to watch over the next few years. Now, the second niche asset class I want to highlight in this video is build-to-rent single-family homes, which have also seen a huge uptick in popularity since the start of 2020. If you follow the housing market at all over the last few years, you know that home prices have exploded, with the average national home value in the US jumping by over 43% since April of 2020. And when you combine these higher prices with mortgage rates that have more than doubled since early 2022, the monthly cost of ownership for homeowners has become completely unaffordable for a huge percentage of Americans. To put this into perspective, in April of 2020, with an average home value in the US of $247,341, assuming a 20% down payment and a 3.5% interest rate, the mortgage payment on that loan would be $889 per month. However, today, with an average home value of $354,711, assuming a 20% down payment again and a 7% interest rate this time, the mortgage payment on this loan would be $1,888 per month. And with most residential home lenders looking for a debt-to-income ratio for borrowers of no more than about 36% of pre-tax pay, an additional payment of almost $12,000 per year means that borrowers now need to make more than $33,000 more per year to afford the same exact house. And while those figures represent the averages throughout the entire country, when you start to look at the average home values in major US cities like San Francisco, where many of the best jobs in the country are located right now, a 20% down payment would require almost $250,000 in cash to put down, not including any closing costs or furnishing costs that inevitably come along with home ownership. And when you look at the monthly cost for a new homeowner in San Francisco, mortgage payments alone could cost more than $6,600 per month. And when you start to factor in property taxes and insurance in a state that many carriers have completely moved out of, you could be looking at close to six figures in annual payments just to own a home. All of these price increases have also been happening at a time when many millennials are now starting to have kids and looking for more space and more of a private option than a multifamily apartment unit can offer, and detached single-family rental units, especially those that are brand new, have become extremely attractive options throughout the United States. According to John Burns' research and consulting data, almost 10% of U.S. homes that broke ground in 2024 were being built as rental units specifically, with a combined $57 billion invested in this sector in 2021 and 2022 to build projects that now are starting to be delivered. More than 120,000 rental homes have been built in the U.S. since 2017, with a record high 34,000 units delivered in 2024 alone, and with renting being almost 27% cheaper than buying in the 50 largest U.S. metros. According to Bankrate data, it's no surprise that this asset class has seen a huge rise in popularity. CBRE actually estimates that this delta between the cost to own and the cost to rent is even bigger, with an average monthly mortgage payment for a newly purchased home being 52% higher than the average monthly rent payment in Q2 of 2024. And in markets like Los Angeles, Austin, Seattle, and San Diego, the average monthly mortgage payment on a home is more than 2.5 times the average monthly rental rate. Major private equity firms have made huge plays in this space in the last few years, with Blackstone acquiring Tricon Residential for $3.5 billion at the start of 2024. And early last year, real estate investment firm Pradium Partners announced they raised almost $1 billion to acquire these homes. And with less than 2% of the SFR market being institutionally owned today, there's still a lot of room to run in this part of the industry. And if you believe in the continued rise in home prices and the continued growth of the US population long term, this could be a really interesting sector to be a part of over the next few years. So if you're trying to find opportunities in a market that right now feels pretty overpriced in virtually all asset classes, I hope this is helpful. And if you're looking to land a job in this industry in 2025 and you want to make sure you have the technical skills you'll need to make it through the interview process at top commercial real estate investment and development firms, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on niche asset classes like these, make sure to hit the like button and let me know in the comments which other niche property types you'd like to see covered in more detail in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.